On a quiet morning in New York, as the sun rises over Wall Street, the numbers on giant screens begin to glow, and in those numbers hides a story that could define America's financial future. In the first few seconds of the trading day, trillions of dollars shift hands, creating instant fortunes and sudden fears. While most people sip coffee unaware of the storm quietly building above them. This is the story of the wealth effect trap, a cycle where rising stock prices make the richest Americans feel unstoppable, pushing markets higher and slowly building a bubble that could one day burst. To understand how this began, we go back to 2008, when the global financial crisis nearly collapsed the entire system, wiping out jobs, homes, and retirement savings across the nation. After that crash, the Federal Reserve, led by Ben Bernanke, slashed interest rates to near zero and launched massive money printing programs known as quantitative easing to save the economy. Cheap money flooded the system, and much of it rushed straight into stocks, real estate, and speculative investments. By 2012, markets had stabilized, and by 2015, the wealth of America's richest families had exploded beyond anything seen in modern history. Billionaires like Jeff Bezos, Elon Musk, Mark Zuckerberg, and Warren Buffett watched their net worth climb at breathtaking speed, fueled by soaring stock prices. As their wealth increased, confidence surged, and that confidence became spending, investment, and risk-taking on a massive scale. Luxury real estate boomed in cities like New York, Miami, Los Angeles, and San Francisco, while private jets, yachts, and rare art reached record-breaking prices. Every new market high created a psychological effect that economists call the wealth effect, where people spend more simply because they feel richer. The richest Americans became the engine of this effect, driving consumption, speculation, and financial risk far beyond historical norms. By 2018, technology stocks were dominating the market, led by companies like Apple, Microsoft, Amazon, Google, Nvidia, and Tesla. These companies were not just businesses anymore. They were symbols of limitless growth in a world addicted to innovation and instant returns. Then came 2020, when the COVID pandemic froze the global economy and forced governments and central banks to unleash the largest stimulus programs in history. The Federal Reserve, under Jerome Powell, cut rates back to zero and injected trillions of dollars into financial markets almost overnight. Stock markets collapsed in March, then rebounded with astonishing speed, creating one of the fastest bull markets ever recorded. During lockdowns, millions of new retail investors joined the market, using apps like Robinhood, inspired by social media, viral stories, and sudden financial freedom dreams. At the same time, the ultra-wealthy doubled down, pouring massive capital into stocks, private equity, crypto, and speculative ventures. By late 2021, America's richest individuals had gained trillions in net worth, while asset prices reached levels many experts called unsustainable. Elon Musk briefly became the richest person in modern history as Tesla shares surged, while Jeff Bezos and Mark Zuckerberg added tens of billions to their fortunes in months. This extreme concentration of wealth created a powerful feedback loop that kept pushing markets higher. When the richest feel richer, they invest more, pushing prices up, which makes them feel even richer, forming a self-reinforcing cycle. Banks, hedge funds, and venture capital firms amplified this effect by offering cheap leverage, encouraging bigger bets and riskier strategies. By 2022, inflation surged, forcing the Federal Reserve to raise interest rates aggressively for the first time in years. Markets stumbled, tech stocks crashed, and billions were wiped out in days. Yet the core wealth structure remained intact. By 2024 and 2025, optimism returned as artificial intelligence, automation, and data infrastructure reignited investor excitement. Companies like Nvidia, Microsoft, and OpenAI became the new stars, promising to reshape every industry. Once again, the wealth effect took control, as soaring stock prices convinced investors that a new golden age had arrived. Yet beneath the surface, warning signs quietly multiplied. Household debt reached record levels. Commercial real estate struggled, regional banks showed stress, and consumer savings slowly declined. Meanwhile, stock valuations climbed far above historical averages, driven largely by concentrated investments from the wealthiest households and institutions. In past cycles, similar patterns preceded major market corrections, including the dot-com bubble of 2000 and the housing crash of 2008. In both cases, extreme optimism blinded investors to growing risks. Today, the same psychology dominates headlines, social media, and financial television. Every dip is bought instantly, every rally is celebrated, and every warning is dismissed as outdated thinking. The wealthiest Americans, with access to insider networks, advanced analytics, and privileged opportunities, continue to dominate capital flows. Their investments shape market direction, corporate strategies, and even government policies. As their wealth expands, political influence grows, allowing favorable regulations, tax advantages, and financial protections to remain in place. This deepens inequality and increases systemic risk, creating an economy increasingly dependent on asset inflation rather than productive growth. For everyday Americans, the consequences are mixed. Retirement accounts grow, but housing becomes unaffordable. Stock gains excite, but living costs rise faster than wages. Confidence rises, but job security weakens as automation and artificial intelligence reshape labor markets. The wealth effect creates an illusion of prosperity while hiding growing structural fragility. If markets fall sharply, consumer spending could collapse, business investment could freeze, and unemployment could spike rapidly. History shows that bubbles rarely end gently. They burst when confidence finally breaks, when liquidity dries up, or when unexpected shocks expose hidden vulnerabilities. The greatest risk today lies not in any single event, but in collective overconfidence. When everyone believes prices can only rise, risk becomes invisible. When wealth feels endless, caution disappears. And when caution disappears, financial stability vanishes with it. Yet this story is not only about danger, but also about awareness and preparation. Smart investors understand that cycles always turn. They diversify across assets, reduce excessive leverage, and prepare emotionally for volatility. They focus on long-term value rather than short-term hype. They invest in businesses with real earnings, strong cash flow, and durable competitive advantages. They keep emergency savings, manage debt carefully, and resist emotional decision-making. Most importantly, they remember that markets reward patience, discipline, and humility. The wealth effect trap teaches a powerful lesson about human psychology and financial behavior. It shows how confidence can become excess, how optimism can become recklessness, and how success can plant the seeds of future failure. America stands at a critical financial crossroads, shaped by innovation, ambition, and unprecedented concentration of wealth. The choices made today will define whether this era becomes a story of sustainable prosperity or a cautionary tale of unchecked excess. The numbers on Wall Street may glitter, but behind them lies a fragile balance between hope and risk. Every investor, policymaker, and citizen now plays a role in determining how this story unfolds. Because in the end, markets do not collapse from fear, they collapse from overconfidence. And the greatest bubbles are built not on bad news, but on extraordinary optimism. So as the screens glow brighter and fortunes grow larger, one question remains. Are we witnessing the foundation of lasting wealth, or standing at the edge of the next great financial reckoning?